Hi everyone. In my earlier two videos, I have discussed the theory relating to lease accounting in the books of a lessee, as well as solved a very simple example relating to this topic. In this video, I take up a more complicated example where I cover multiple adjustments so that you will be able to handle any question on this topic that you get in your exams. All right. So we do a quick reading of the problem first before we go into the solution. Mr. X leases machine from Mr. Y for a period of 10 years. He has the option to terminate the lease at the end of year 3. He has the option to extend the lease by a further 5 years. He also has an option to buy the property at a price of 4.5 million at the end of the lease term. The fair value of the underlying asset at the beginning of the lease term is $6.5 million and its economic life is 30 years. It is reasonably certain that Mr. X will buy the property at the end of the lease term. Mr. X pays $100,000 at the inception of the lease. Mr. Y will give an incentive of $300,000 in the beginning of the 5th year. The first annual payment will be $750,000, which will increase by 2% every year. He also needs to pay $2 per unit produced by the machine. It is expected that the machine will produce 50,000 units every year. Mr. X incurs an initial direct cost of $100,000. The implicit rate in the lease is not available, and Mr. X uses his incremental borrowing rate of 12% to discount the cash flows. How will this transaction be recorded in Mr. X's books of accounts? So, Mr. X is the lessee and Mr. Y is the lessor. Okay, let's do a summary. Let's go one by one. First of all, we know that Mr. X leases the machine for a period of 10 years. He has the option to terminate the lease at the end of year 3. It is reasonably certain that he will buy the asset. So there's no question of him terminating the lease. He has the option to extend the lease by a further 5 years. This again is not relevant. Why? Because we know that at the end of the lease term, he intends to buy. So in this case, the lease term is the original lease term of 10 years. He has an option to buy the property at a price of $4.5 million. The fair value of the underlying asset at the beginning of the lease term is $6.5 million. The economic life is 30 years. It is reasonably certain that he will buy the property at the end of the lease term, which means the exercise price of purchase option needs to be added to the present value of lease liability. Mr. X pays $100,000 at the inception of the lease. Please remember that we record the lease in the books of account only on the commencement of the lease. Since this has happened at the inception of the lease, this is definitely an advance lease payment. Incentive from the lessor is $300,000 at the beginning of the 5th year. The first annual payment will be $750,000 and will increase by 2% per annum. He also needs to pay $2 per unit produced by the machine. It is expected that the machine will produce 50,000 units every year. It's definitely a variable payment. It's not a fixed payment. But is it a variable payment based on an index? No, it is a variable payment based on actual usage, and therefore this amount will not be used in calculating your lease liability or your ROU asset. If in the question they have clearly specified how many units were produced in each year, then we would pass entries expensing out the variable lease payment every year. Now there is an initial direct cost of 100,000. The implicit rate is not available and the incremental rate is 12%. Alright, so now we have all the important information. Let's go on to the solution. Like I discussed in the previous example, please look at solved questions of your examination to understand the format in which your solution is expected. I like to give the accounting entries in the first year and a simple table which shows the balances of the various components in the financial statements. Let's go to the first working note. This is common, like I said, across all lease accounting problems. It is to calculate the present value of the future cash flows. The first cash flow that they are saying over here is 750,000. Now, if you look closely, you will see that it is not clear whether this payment will be made at the end of the year or the beginning of the year. But we have a clue in the sense that the incentive is given at the beginning of the fifth year. So, we can assume that the payments are made at the beginning of the year. Please write the assumption so the examiner can take that into account. Alright, so at the beginning, when lease payments are made at the beginning of the year, I have discussed in my earlier video on present value how the calculation differs when payments are made at the beginning and the end of the year. I have given the link to this video in the description. Right, so the payment made at the beginning of the first year will be shown as 0. Go on considering the beginning of the year. The payment made at the beginning of the 10th year will be considered as the end of the 9th year. So all of these are annual lease payments. Let's look at the cash flow. It starts off with 750,000 and then there is an increase by 2% per annum. There is an incentive that is given of 300,000 at the beginning of the 5th year, which means the end of the 4th year over here. If you're not very sure, you can just start counting. 1, 2, 3, 4, 5. This has to be subtracting the incentive of 3 years. But you see, when you do these kind of changes, all your below values get changed because they're connected by formula. So you need to change the formula of this particular year. And we're back to normal. Right? Now we come to discounting factor. At what rate is it? It is 12%. And we calculate the formula as 1 divided by 1.12 to the power of the year. Discounting factor of today will always be 1. Copy that across. Okay. And now the present value of the cash flows is easy. Now what do they say? They say that at the end of the lease term ends at the end of the 10th year. So it's not the beginning of the 10th year, but at the end of the 10th year, there is a purchase option. And they say that the payment that will be made at the end of the 10th year will be $4.5 million. So, what is the lease liability? The lease liability comes to 6,361,362. The first entry that will be passed is on the date of inception when you made an advance lease payment to the amount of 100,000. It's bank credit. The second journal entry is on the date of commencement when you are recording the lease. ROU Asset debit, lease liability credit. We know the amount. We pick it up from here. And then there's also an advance lease payment that we did. So let's consider that here. The initial, oh yes, the initial direct cost, that will also come here. Now we get our ROU asset, which is sum of all of these three put together, which will more or less be equal to the fair value of the asset of 6.5 million. Yes. Okay, now we go on to working note 2, which is to compute the closing balance in the lease liability. So we have 10 years. The opening balance is 6,361,000. Now over here, you remember the annual lease payments are made at the beginning of the year. So before interest is calculated, there is a repayment that is done. Let's take that repayment into consideration first. Then the interest, which is at the rate of 12%, will be calculated on the opening balance minus the repayment. And the closing balance is opening balance minus repayment plus the interest. We go again. The closing balance of the previous year is our opening balance. There is a repayment made. The interest will be 12% of the opening balance minus the repayment. The closing balance is the opening balance minus replacement plus interest. And this is what I will copy across. Now you remember in the last example I told you that the accuracy of your problem you check by looking that the closing balance at the end of the lease term should be 0. Here it is not 0. It is, if you look closely, the purchase price that the lessee will pay at the end of year 10. Right? So this is a correct calculation. Now we come to the ROU asset. Same thing. We're talking about 10 years. You take the opening balance of the ROU asset from your journal entry. The depreciation is done on a straight line basis. But since the lessee is reasonably certain to buy the asset, so you will consider the entire economic life of the asset and not just the lease term. So in this case, it would be opening balance divided by an economic life of 30 years. The closing balance is just that. I do it once again so that you're clear. The closing balance becomes next year's opening balance. The depreciation does not change. So over here also, I told you in my last example that it should be a 0. But that is only in the case when you depreciate the whole value of the asset over the lease term. In this case, it will further continue for another 20 years, and at the end of 30 years, that's when the asset value turns 0. Right, now let's pass our entries. Even at the beginning of the year itself, there is a lease liability debit, that is the repayment of the lease liability for 750,000. Then you have depreciation, account debit, the value of the asset, the interest on the lease liability, which we collect from here, and finally we take both interest and depreciation to the P&L account. We come down to the closing balances of the various values. This is very simple. You've already calculated it. You take this from the working note 3. The lease liability you take from working note 2. The depreciation from working note 3, which is the same across the years, the interest from working note 2. Right, so we've come to the end of the video. In this video, I discussed how leases are recorded in the books of accounts of the lessee. I will be doing more videos covering lessor accounting, sale and leaseback transaction, and remeasurement of the leases. In the meantime, please feel free to share your suggestions for improvement or any queries that you may have on anything that was discussed in this video. Thanks very much for watching this video. Really hope that you found this helpful. Bye.